All right, so now I'm going to do a short video on bank reconciliations. Okay, so the idea of what a bank reconciliation is you're going to get your bank statement. Okay, and on your bank statement, it's going to provide a whole bunch of transactions. And then with your accounting records, what we call the book, you also have a whole bunch of transactions. Okay, now there's a timing difference between the two. Some things the bank is going to know about that we don't know about yet. Okay, and it's not that we won't know about it ever, but we just don't know about it right in that very second. Okay, or that moment or whatever. And there are some things that we know about that we've recorded in our accounting records that the bank just doesn't know about yet. Now they will know about them, probably, most likely, but they don't know about it right that second. So we're dealing with bank deposits, checks, just things we call cash. Okay, so it's all very liquid transactions, and we're just trying to find the true balance. Okay, and so I have a list of basically all of the adjustments that need to be made, all of the reconciliation items that I'll go through, and it just has what you do to the bank or the book. But I'm going to explain more of what the logic the logic that I use, sorry. And it's because I don't memorize these, okay? Now, some of you may prefer to memorize it, but I wouldn't recommend it. I would prefer that you really just understand the concept behind it. That takes less brain power. Like if you can understand the principle, then memorize the principle, and then you don't have to memorize each specific detail. Instead, you just apply the principle to it. Okay, so let's look at this first one. So deposit in transit. Okay, so the way I look at this is I say to myself, okay, who makes deposits into the bank account? We do, right? And so clearly we know, as you know, in our accounting records, we know that we made a deposit to the bank. Okay, so we know that. And so the adjustment must need to be made to the bank. Okay, and you'll say, well, wait a second, if we deposited the money in the bank, why don't they know about it? Because we could deposit it on, let's say, a Sunday night. Okay, the bank is closed, but we can go to the after hours drop box and make a deposit in the bank. Okay, and so we know about the deposit, but they don't know about it. Okay, deposits increase bank balances, right? And so we would add it to the bank, because the bank just doesn't know yet. Now you're going to say, like, wait a second, they're going to know tomorrow or the next day. They're going to know really soon. And that's true. But, you know, with a bank reconciliation, we're doing a reconciliation for that very moment. Okay. And so the first thing that could happen is we deposit money. The bank doesn't know about it. So we need to add it to the bank balance. Okay. Next one, outstanding checks. Okay. So think about this. Who wrote the checks? We wrote the checks, right? So we wrote checks, we handed them out to our employees, we handed them out to vendors, whoever, right? We write these checks, okay? So we know about them, okay? But for whatever reason, the person who received the check, they haven't cashed it yet, okay? And so until it's cashed, the bank doesn't know about it, right? So we know about it, the bank doesn't know about it. So think about a check that's going to reduce our bank account, right? It's going to reduce the balance in our bank, okay? And so we need to deduct it from the bank. All right, next one, service charges, okay? I hate service charges. So service charges, that's something that for whatever reason, the bank is charging us for something, okay? So they could be charging us because we didn't maintain a certain balance, or they may charge us because we did a wire transfer or cashier's check or whatever. It's normally nitpicky stuff that they charge us, right? So the bank knows about the service charge. We don't know about it until we see the bank statement, okay? So in that case, we're going to reduce it from our book balance, okay? Our books have this balance of cash that we show, and the service charge is going to reduce that balance. Okay, bank collections. Okay, so what a bank collection is maybe we bank with the same bank as some of our customers, okay? And so instead of our customers writing us checks and mailing the checks, instead they just put it directly into our bank account, okay? And we just have an agreement set up where they can do that. Well, when they make that deposit, essentially, the bank knows about it, but technically we don't know about it right that moment, okay? Until, maybe they send us an email and they say, hey, we've paid that invoice or whatever. But bottom line, the bank knows about it because it's been deposited in the bank and we don't know about it. So we need to add it to our book balance, okay? So that's why it's saying add to book or books. Okay, errors. Okay, an error is simply, someone made a mistake. So whoever made the error, we need to make the correction in their record. So if the bank made the error, we need to correct it with the bank. If we made the error, we need to correct it on our books. So think about, we should have recorded something for $100. Instead, an expense, let's say, we should have recorded a $100 expense. Okay, instead, we made a mistake. We added an extra zero. We recorded an expense of $1,000. Okay, so we would need to add back to our books $900 to get us back to the expense of $100 to fix the error. Okay, so it's really the difference between the correct amount and the error. All right. Non-sufficient funds, NSF. Okay, so your non-sufficient funds, basically what's happening there is someone gave us a check, right? And we went and cashed that check. We thought it was money in the bank, essentially. And then the bank lets us know later on that, sorry, that person didn't have the money to clear that check, or that check didn't clear the bank. Okay, and so a non-sufficient funds check, the bank knows about it. We didn't know about it. We thought it was money in our books. And so we need to reduce down or deduct from our books. All right, interest income. Interest income, interest rates are so low right now, you don't earn much interest income, but the bank could, if you have a money market account or a CD or something like that. So, the money in the bank is generating income, interest income. We don't technically know about it until we see our statement, is the idea. Okay, and so we would add that to our books. Okay, so now let me go. So that's a little bit abstract, but let's go look at an example. Hopefully that will make it. It'll solidify it. Okay. What's going on here? This isn't good. There we go. Okay. So this example here. Okay, so Burbank Company's records reflect $12,650 cash balance. Okay, so I'm just going to say books. Okay, so that's like our accounting records, right? Or is the books. I mean, you could say accounting records or something, but we're going to okay, we're going to start out with 12,650. Okay. Now what we need to do is go find the bank balance. Okay? And they're not going to match up, right? Because they're kind of looking at it from different perspectives. So let's see here. Burbank's November bank statement reports following amounts. Okay, so bank, we're going to have starting balance of 10,050. Okay, so neither one of them is wrong. They just don't have the complete picture, right? So there's our book starting balance, 12,650, and our bank balance, 10,050. Okay, now we just go and start to make our adjustments. Okay, so bank service charge, $10. Okay, the bank knows about that, right? But we don't know about it, so we need to go -10 and just put it in. I mean, the accounting software is going to make you label everything. So do it obviously for MyLab Accounting, but on the test, you can just do this, and kind of just put it in as a positive or negative. NSF check, non-sufficient funds check. Okay, so this is money that we thought we had received, but we didn't, right? So we need to go $90, subtract that from the books. Because we recorded it, it was in this balance, but it shouldn't have been because we didn't actually get paid. Okay, deposits in transit equal $3,000. Okay, so that's money that we know about. We deposited it, but the bank doesn't know about it because it's in transit. Okay, transit just means, think of like the transit authority or something like that. It means that it's in motion or it hasn't arrived yet, right? So that deposits in transit is going to increase as soon as it arrives at the bank, or as soon as the bank records it, really, then that's going to increase the bank balance. Okay, outstanding checks, again, the bank doesn't know about those, right? We wrote those, so we know about them, but the bank doesn't know. Those checks, as soon as they're cashed, they're going to reduce down and then determine Burbank's in November 30th, year 3 adjusted cash balance. So at this point, we're going to sum both sides. We're going to sum both sides, and we should balance. Okay, we've done everything right, and that's the nice thing is that you can kind of check your work. We should balance. Okay, so 12,550, 12,550. So everything balances. Remember, I'm not really like memorizing this stuff. Instead, I'm just using the logic of who knows about this, who doesn't know about it, where do I need to make the adjustment. Okay, let's look at one more. Cash account has a balance, so I'll try and keep it the same way. So we're going to say book. And then okay. So cash account has a balance of 2,560. Okay. Outstanding. And then I'm just going to skim through and try and find where it has the bank. Okay. The bank statement listed a December 31st balance of 4,360. Okay. 4,360. So I just got my balances right off. Okay. Now I can go through and start making the adjustments. Okay. Outstanding checks totaling $1,300. So outstanding checks, those are checks that we've written, we know about them, but the bank doesn't know about them yet, right? So they're going to, as soon as those people cash the checks, it's going to reduce the bank balance. Deposit in transit of $100. Okay, we also know about that, right? The book knows about that. We made the deposit, but it's in transit, so the bank doesn't know. A deposit increases the bank balance. Bank statement listed that. Included in the balance is a direct payment of $610 from a customer. Okay, so direct payment of $610 from the customer. Okay, so the bank knows about that. We don't know about it yet, right? We need to increase our book balance. Statement also shows a $30 service charge. Okay, we didn't know about that. People nickel and diming us, right? No, but interest revenue of $20. So that's a good thing, right? We didn't know about that also, so we need to add that to our books. Then we just sum and make sure they agree now. If they don't agree, we know we've messed up. They agree, so we're good there. So that's kind of examples on bank reconciliations. Hopefully you like doing those, you know, practice enough of those that you do like them, that you understand them, because they'll definitely be on the test. Okay, let me know if you have any questions or if you want me to provide more examples. Thank you for watching. Have a nice day.